Today's question that we're going to answer is, how does inflation impact the overall stock markets and economy? Well, inflation, remember, is the value of goods, or the price of goods more specifically, and services, and how they go up over time. Frequently, the government measures this through what's called the CPI, which is the Consumer Price Index. This is a fixed basket of goods. That basket typically does not change year to year, and what they do is they take average pricing that's in that basket and compare its prices year over year. What's in the basket? Things like a gallon of milk, a gallon of gasoline, average rent, certain items of clothing, certain food items. Those are the items that we are the most concerned about, and we want to keep track of that from a personal budget standpoint. We also want to keep track of it when we're in retirement or in a cash flow situation where we're living on that fixed income or variable income. We want to make sure that we're protecting against inflation. However, let's move on to what inflation can do to the overall stock markets. Ronald Reagan said that inflation is the cruelest tax of all to those who can least afford it. What he meant was that people who are on a fixed income that don't have significant assets tend to end up paying more and more for things on less and less money on a relative basis, so they're living a lower and lower lifestyle. The flip side of that, I think, is pretty interesting, and that is, if you own assets, your home, a stock portfolio, those assets tend to go up with inflation over time, or even exceed inflation over time in the case of the stock market. So you can actually create more wealth in an inflationary cycle. Plus, keep in mind that inflation can actually be stimulative, certainly at lower levels. Now, when inflation gets into the high single digits or double digits, this certainly may not be true. However, think about it from a consumer behavior standpoint. If you are assured that that new car that you want to buy or that item of clothing is going to cost significantly more a year from now than it does today, if you can find it due to limited supply, then you're probably going to run out and spend the money now. Deflation is the other side of that coin. Deflation can be quite bad for the overall economy because people tend to hang on to cash. If they think that a year from now that car is going to be costing less than it does today, or the same, they'll hold on to that cash, trying to get a better deal. However, if prices are increasing with inflation, then you might want to separate yourself from that cash in a hurry to go ahead and buy that item while it's available. So inflation, it can be a bit of a double-edged sword, but if you stick to investments where they have some pricing power and they can continue to raise the price of their goods and services, then you're going to be protected from an earnings standpoint. Keep in mind, inflation means that asset prices also go up. So if you have assets, they tend to go up with inflation. So that question for today was, how does inflation impact the overall investment in stock markets? Thank you. Thanks for visiting our channel. We hope you found the information valuable. If you want to see more videos about investing, please click to subscribe. If you have any questions you'd like for us to answer, please send us an email to harvey@riagroups.com. We would love your feedback.